I'm Michael Fox, and this is the Prospector News Podcast. And I am on location at the Current Trends in Mining Finance Conference put on by the New York chapter of the SME. And I'm joined by returning guest and in person, the senior commodities analyst at Bloomberg Intelligence, Mike McGlone. Welcome, Mike.
Thank you, Mike. It's good to see you again.
Absolutely. Our paths are starting to cross themselves a little bit more frequently in both of our travels. Yeah. Although realistically, we were crossing paths just enough to kind of wave at each other over the room.
Yeah.
It's nice that we're able to do these on a regular basis. So since we last talked, I think we spoke in around PDAC. So that was back in March. Commodities have been on an absolute tear. Yeah. And I'm trying to make sense of it because seasonality should say that they should be ticking down slowly. We're coming up on the American Memorial Day weekend. That's usually sell and may go away. None of that's happening this year. What's your take on all of this?
Well, I appreciate that sell and may go away. That actually originated in agriculture and grains. And we both were from the grain belt of Canada and the U.S. With production coming on. But I think what's happening is there's been a significant allocation to commodities. And the way I see it is most of them, particularly it's the metals, industrial metals, everything else is somewhat languishing, catching up to gold. And why are they catching up to gold? Because gold has been the only major commodity at the end of Q1 that closed an all-time record high. Stock market didn't, Bitcoin didn't, gold did. And now we have copper and a lot of the industrial metals catching up. And a lot of that's because of beta. So I wrote about this a month or two ago. The Bloomberg Commodity Index reached a quarter century low versus the S&P 500 stock market index. So that's attracting money into metals and commodities, but not so much crude oil. I mean, crude oil right now, as we speak, is like $78 a barrel in WTI. That was first traded in 2007. I'm still bearish crude oil, but the one thing I like to point over time is the commodities that usually perform the best are the metals. So we have a Bloomberg All Metals Total Return Index. It's up 20% this year. The problem I see in commodities is everything's catching up to gold, and there's that high connection, high beta between industrial metals, copper, and beta, the stock market. And the issue I see is like, I wanted to point this out. If you look at the price of copper, right as we speak, is $5.10 a pound. It just made a new high, $5.20. And you overlay it with the S&P 500. Just take the S&P 500, divide by 1,000. It's the same price of copper since 2015. So you can make the argument copper's just catching up to beta. But the risk to me is everything starts rolling over. And I'll point that out. Why? Because let's look at a year ago. The market tilted way too much towards a recession in the U.S. Didn't happen. Now it's tilted way too much towards no recession, no landing. I think it's just going to tilt back a little bit. And to me, that's why I stick with the bottom line commodities, the most enduring performer in history. And I think this year will remain gold.
Okay, so gold has been on a tear. It's up about $400 since, well, at least since the beginning of the year. And I would suggest that most of that has happened since PDAC, which is the first weekend in March. And again, this is a counter seasonality trend. Like gold, usually they refer to it as the PDAC curse. And, the commodities roll over a few weeks after the PDAC. A lot of it has to do with, the typical period that the companies raise funds for their, drill programs that are going to occur in the summer and the fall. But it's not happening this year. In fact, gold has hit new high after new high after new high. When it broke through 2,100, I had an analyst saying, yeah, if we get to close above 2,200, everything, game's on and we're off. Well, it blew past 2,200, blew past 2,300. Now it's 2,400. What's driving the gold price?
China. Number one thing, let's start with the macro. First of all, I think it's a matter of time that gold gets to $3,000 an ounce. I think 2,200 is now good support. Remember, we bumped up against that resistance at $2,000 an ounce for 3 years, almost 4 years. People like me looked like idiots. Admit, I've been early, I've been wrong. I've been thinking this for too long. It's going to $3,000 an ounce. But the world shifted with the unlimited friendship between President Xi of China and President Putin of Russia. That's part of what's kicking in with gold. Some of the axis of antagonists and some other entities in the world are looking for an alternative to the dollar. And the biggest buyer of gold, according to the World Gold Council, is central banks are buying at a colossal pace, and China's leading that. So put some numbers on it. And that's happening at the same time gold ETFs have been significant outflows, which is probably bottoming right as we speak. So to me, the thing about gold is historically, let's look at gold. I like to look at gold versus S&P 500 and overlay the S&P 500 versus GDP. On those two metrics, the S&P 500 or the stock market, US stock market versus GDP, and gold and stock market versus gold, those two markets makes gold look the cheapest it's been in 100 years based on those two combined. So I look at gold just catching up to the expensive beta. The biggest, deepest pockets on the planet are buying. That's central banks led by China, and there's a reason for it. They tilted towards Russia and this new world order of antagonists. And the bottom line is rally has happened despite significant outflows in gold ETFs. So we're at the point now, there's been 30 million ounces of outflows from total gold ETFs. We're down to 80 million ounces from 110. This is since 2020. And there's been about 100 million ounces of central bank buying. Now, and I was on a panel here recently, and some people pushed back, and I said, well, price has verified that. The price of gold has rallied despite that. So to me, it's the next step is gold is more likely to accelerate higher when the main metric that's keeping people away from gold ETFs shifts. And that is the quote I like to use: why buy gold when the stock market's on a tear and you can get 5% in T-bills? That's going to revert. It's a question of when. I think it's going to start this year. I can point out versus GDP, the US stock market capitalization is 2 times GDP. That's the highest since 1930s. So it's very expensive, the stock market. And here's the numbers. The bottom line is at some point when we see some reversion in the stock market, then rates in the US can go down. Rates in the US can't really go down until the stock market goes down, because the stock market's such a big part of the whole world now. It's driving up inflation by going up. So the point I like to make is we're going to start seeing some inflows into gold ETFs once stock market goes down, inflation and interest rates go down, and that might accelerate gold higher. The question is when and from what catalyst. So I look at gold as it's the most enduring commodity, and I look at gold versus copper, enduring upward trend, and I think it's going to continue. Recently, there's been a little blip in that. Gold versus silver, enduring upward trend, at least a blip in that trend. Gold versus crude oil, breaking out today. It's around 31 barrels of WTI to an ounce of gold. To me, that's breaking out, and that's the most significant thing that's happening to commodities. I'll end with this. Gold typically outperforms almost all commodities over time, particularly when the world's heading towards recession. If you look at bond yields in the rest of the world, particularly China, 10-year note yields in China are 200 basis points below the US. Those are signs of deflationary forces from China. The key thing you learn in commodities is ignore what they say, watch what they do, and bond yields are pointing that way.
I see. And you mentioned the stock market. You say that gold will start to accelerate when the stock market goes down. The stock market itself and the market analysts seem to be pricing in rate cuts sooner than later again, based on the latest inflation numbers. But inflation is still high. There's other factors out there. We're not in deflation in the West, unlike China. If the markets continue to be ebullient, how much longer can this gold rally if we're going to have to wait for the markets to shift downward?
So I think I'm glad you brought that out. And what you can't see in our audio recording is me smiling when you said that the markets are pricing for easing. To me, it's somewhat inconceivable. It's actually silly for markets to price for Fed easing, with the stock market being such a significant part of GDP and going up and driving inflation above its metrics. And for the Fed to ease with the stock market on a massive speculative frenzy like it is, you can say, and inflation above its targets is just silly. It doesn't happen, particularly after that mistake of too much liquidity and inflation, which is the biggest problem, at least it was, it's going down for the last 2 years. So I hate to go there, but when you have metrics that are this high for the equity market, I had very similar signals in 1999, very similar signals in 2007. It's just much more expensive now. So I'll give you key specifics about why, as a commodity strategist, I have to go to that. So first of all, let's look at the gold S&P, the S&P 500 gold ratio. We go back 100 years on Bloomberg data. You can go back to when we came off the gold standard in 1971. Typically, it's 1-to-1. Every time it gets about 2-to-1, it's expensive. And you got a recession, gold almost always outperforms. And when it gets lower, the stock market outperforms. Right now, it's about 2.2-to-1, the ratio of the S&P 500 to gold. And then we have issues of I mentioned versus GDP, the S&P 500 is very expensive. Volatility. the number one rule you learn, like I learned trading options my whole life, is volatility is always mean reverting. So the VIX volatility index, you look at that index, subtract out T-bills, it's a T-bill rate, and that average, just a 20-week or 50-week average, is the lowest since 2007. That was a big signal I had back then that we're just going to have a reversion in the stock market. So volatility is extremely low in the stock market, which means at some point it'll revert higher. And then you look at the stock market versus the rest of the world, S&P versus S&P, the MSCI ex-US, the highest ever. It's very expensive there. And then one other simple thing. I've been publishing recently two things. I look at the S&P 500 versus its 100-week moving average. Right now, it's 22% above that average. It's very rare to get that high and stay that high. If you overlay that with the gold-silver and gold-copper ratio, every single time we get that extended in the stock market, it's usually a sign that gold's going to outperform silver and copper. Why? Because beta mean reverts from getting too expensive. Gold outperforms the two highly sensitive economic commodities, mostly copper, but silver's much more in that copper bucket now. It's much less in the gold bucket. It's the world's shifted. Silver's much more an industrial metal.
Yeah, we'll get back to silver in a minute. I'm in the camp that you are, is that I see the stock market going back to a mean reversion here. What concerns me is that it's so overpriced. Is it going to be a shock, or is it going to be a gradual?
The answer is yes. No clue. Never know what happens, but it's a lesson I learned in trading. When the markets get this stretched, it's basically like a tinderbox sinking a spark. It just takes a spark for mean reversion. 2000 was a spark. The market just was way too expensive. In fact, right now, the stock market versus GDP is much more expensive than it was in 2000 at the peak. It's more expensive versus GDP than it was at the peak in 2007. And that's US. So it's very stretched. And we have this situation where it keeps going up. It's lifting inflation, but it's animal spirits. It's lifting everybody's feeling of wealth and everything. And at some point that always reverts backwards. What's the spark going to be? I don't know. Could be related to election. It could be a number of things, but I like to point out is we are seeing severe deflationary forces come out of China. Why? You don't have to take my word for it. Virtually every country now is putting more and more tariffs on China, and the massive outflow of electric vehicles and solar panels, because they shifted a lot of their attention from the property market to exports and exporting renewable type energy things. Pressuring inflation on a global basis. So to me, it's likely catalyst is just a simple reversion of rapid growth in China, just what Japan did. A lot of us lived through that. I worked for Japanese firms when Japanese GDP peaked at 4 trillion in 1990. It's still about the same. That's happening in China now. So I look at it as as far as predicting catalysts, it's usually the high price cure. It's just a question of time.
Okay. So there's nothing on the horizon necessarily that we should be watching out for. Just we know there's something on the horizon. We just don't know what it is.
I'll give you signals. So I'm a commodity guy. First of all, that we have, remember that thing called the inverted yield curve? Almost the longest period in history. I think we're almost 2 years now into the inverted curve in the US. It always has signaled recessions. Yes, it didn't happen last time, but we've had the biggest fiscal stimulus ever in this country outside of war or recession. So that to me is a key factor. And then the things I see for commodities. In the US, we have recessionary downward trajectories in demand for diesel. I mean, the grease of the global and the US economy is diesel. Downward trajectories in diesel, very similar to right before the financial crisis. Unleaded gasoline demand. Now, I'm not talking about monthly. These are 52-week average. Analyze demand pull for these two key sources of petroleum heading lower, in addition to container boards. Boxes, corrugated boxes. When I was a bond trader, we always looked at corrugated boxes as a key indication. Anything you buy from Amazon, the real economy, corrugated boxes demand is dropping at the same pace. It's actually below it was pre-COVID. I don't remember exact number. My colleague Ryan Fox on the team does that. But all these signals are tilting towards a recession that usually I think what's going to happen is no one's going to go back to these indicators until the stock market tells them they should start focusing on it. And right now, that's all that matters. The stocks are going up.
Yeah. Well, I had a earlier discussion about ebullience versus capitulation, and we're definitely on the ebullient side of the swing here. Let's go revisit silver. I think it was our very first podcast we did together in Miami several months ago. We talked about silver and whether the silver gold ratio was was relevant anymore, in that silver was increasingly more an industrial metal, and we discussed whether it should be a silver copper ratio instead. Silver's taken off. It's outperformed gold even in the last several weeks. And the question I have is this one of those periods of time where silver is acting more like a precious metal than an industrial metal again?
I think it's catching up to copper, most notably. Silver gets some great technical signals. I was wrong initially. I have to admit that to our listeners. But once it broke above 26, it broke above that resistance. That was its signal. Now it's 32. I think it's converted 30 resistance to support now. But it is there's potentially speculation, and makes sense that China is potentially hoarding silver. They're definitely the biggest buyers of gold and potentially copper. It makes sense they would be doing that. But it's known as the devil's metal for a reason, because all the signals are, once silver spikes like this, you got to watch out. And I point out is silver will do well in a global economy that's got demand pull and doing well, and stock markets are going up. But I pointed out the one thing I overlay is that S&P 500, when it gets stretched 20% above its 100-week moving average, gold silver ratio, almost always gold outperforms silver, because that S&P beta has to revert. I put gold and copper in that same bucket. Silver to me is much more like copper now. That's part of the reason it's breaking out higher. But I like to caution, and anybody who's traded silver, as long as you and I have known it, knows that you got to be very careful with silver when buying it after it goes up. And you got to have good tight stops. And from an investment standpoint, bottom line, I like to point out is central banks are not buying silver, they're buying gold. But there's evidence, not evidence, but it makes sense that China's buying it. I look at silver as gold should outperform, particularly you look at Chinese bond yields, they're plunging. That's an indication of global economy contracting in China. You look at the US stock market, volatility is so low, I point out. So those are good signs that the silver gold ratio, which has been going up historically over time, is more of a dip in the upward trend than something new, is the way I look at it. So I think silver is more likely to go higher. I mean, gold outperforming silver.
Yes, but if I'm hearing you correctly, you're expecting that it's just a question that gold's going to outperform silver, not that necessarily silver is going to decline from this point.
Yeah, good. Exactly. I think 30 is now support. I'm more worried that, like I see, look at as an ex-trader. One thing about copper and silver is they're very autocorrelated metals. Gold's less; it's the least autocorrelated of all the commodities, and partly because you can't bring out in supply, but it's also the traders. And so I look at let's start with copper. I think copper is very likely peaked around 5. I think it's more likely to see $4 a pound than 6. At some point, it's going to get to 6, but it might take years. But more likely to revert towards 4. And at some point, and then maybe move higher. Silver potentially the same. It might get down. I don't think it goes back to 26, but 30 is good support. It's just kind of a little difficult. Silver's a little more difficult. I feel more confident about the backup in copper because of that more industrial base. So we'll see how that works out. But right now, it looks like 30 is now support in silver. I just look at gold. At some point, it's going to 3,000. Questions when? Probably pull along silver, and it's less likely to pull along copper.
Yes, silver, I've always likened the market to a game of musical chairs. You better be pretty quick to find a seat if it turns on you. So I keep laughing, and I keep hearing the 3,000. I remember very vividly last year, Rob McEwen was here, and he kept predicting $3,000 gold at the same time. And his voice, like yours, was in the minority, and he said he'd be dancing in the hallways here if gold was going to go to 3,000. So I think he's found a dance partner in you.
Yeah, well, that's the key thing about people like us. When everybody agrees with you, the red flags there. You want to have disdain when you put out a call that you think is very profound and logical. And it's very simple. We know gold has overall supply increases 2% a year, and it's not getting easier to create more supply of gold. It's ASG and everything. But there's unlimited supply of fiat money. It's priced in. Central banks creating fiat money and buying gold makes sense. The price will go up eventually to 10,000, just a question of time. The way I like to point out with gold, though, with the world moving so rapidly in technology, is having gold without some Bitcoin in that space may be a bit risky. So I put the two together. And it's just obviously there's an index in the Bloomberg terminal that weights it by volatility. So it's about 70% gold, maybe 20 to 30% Bitcoin. And that's for me is part of in that bucket now.
Yeah, it's interesting. I was at a conference last fall. I always looked at precious metals and Bitcoin as a cattleman versus a sheep rancher in the old West. The two of them were never going to get along, and I was quite shocked at the number of, I call them crypto kids, that were walking around saying, "Yeah, we make our money in crypto, but we protect it with gold."
Exactly. I love that. That to me makes sense. And you ask your typical 30 or less something. I have 4 children that are about that age. They don't care about gold. They're more involved in cryptos. And there's so many now you can just buy an ETF and say, yeah, I'll put some of that in my portfolio. Even Bloomberg Indexing published recently that having crypto as a diversifier. We all know gold is more of a diversifier as a store of value. But I just like to say very simplistically, not knowing exactly where the future is going to be, but having pure gold and no Bitcoin, I think, is a kind of inordinate risk. You got to have some Bitcoin in that space to just follow trends of diversification. And the world's going digital, and this is digital gold.
We weren't going to talk about Bitcoin, but we've gone down that rabbit hole. So very recently, they have gone through their halving process again, and now it's going to take twice as much energy to get a Bitcoin. Is this bullish for Bitcoin, bearish, or is it stabilize it?
So I appreciate the way you started that. We don't really want to go there, but I think it's remiss to speak about gold without focusing on the rapidly advancing technology and the digital version of gold, which is Bitcoin. So that's what captured me about this digital version of gold years ago, 2016, 17, is that definable diminishing supply. So at the moment, you can only create 450 coins a day on a global basis. And 4 years from now, it'll be 225. It's just that definable diminishing supply. Simple rules of economics. If you have increasing demand and adoption, price must go up over time. The key thing I like to point out is Bitcoin basically trades with volatility about 3 times gold and 3 times the S&P 500. So when we do have a correction in the S&P 500, Bitcoin's more likely to suffer than gold. It's going to be at some point, and then it's come out of it ahead of time. But it's the test. I'm waiting for a test. So this year so far, we've only had one correction in this S&P 500, 5%. Last year, we at least had that 10% correction, and it's set the stage for where we are now. That's why I see the problem is a lot of people are adding Bitcoin to portfolios. It's becoming part of the natural portfolio mix. It's early days, but I think they're going to find out that it's not like gold, which basically has a zero and sometimes negative correlation to the stock market.
Yeah. So when I heard about the halving and I started to look at the economics of it, what concerned me was the challenge that the actual Bitcoin miners have in that they're essentially doubling their cost of production to get a single Bitcoin.
Yeah.
And I kind of looked at that. Okay, if I'm any other miner or business and my business costs double, how long am I going to stay in business? And that was kind of the question I would have about the Bitcoin miners. How, is the halving going to cause these Bitcoin miners to lose out and go out of business, or is it just going to get rid of the Bitcoin miners with the weaker hands?
So I think it's more the latter, but it's one of those things, it's so definable. We know exactly what supply is going to be over time. If you're a Bitcoin miner, it's a known. You just have to adjust accordingly. Now, bottom line is make sure your cost of production is cheap as possible. And maybe that means that the better investment is in the actual Bitcoin than the actual companies that create them, the miners. I'm not saying I know for sure which one it is. I'm sure a basket of miners might do well, but that's where Bitcoin has its advantage is you cannot have that high price cure. No other commodity on the planet has that. The least elastic in terms of supply elasticity is gold. You look at crude oil and corn and natural gas. Why have they collapsed? Because the elasticity supply, you do not have that in Bitcoin. So I look at it from an underlying commodity strategist. The underlying price should go up over time. It's called NG technology. You might have heard of this. Number go up. It's very sophisticated.
Yeah.
But yeah, the miners, it's another story. I'm not in the equity side.
Wonderful. We've crossed a lot of bridges. We've brought everything up to date with the nature of the commodities, and I look forward to our next chat. If people want to follow your work, how's it best to do so?
Well, I always appreciate catching up, Mike, because your questions are good. You really make me think about, and then I get ideas what I want to write about. So I'm the Bloomberg Terminal. I'm on LinkedIn, Mike McGlone, Senior Commodity Strategist, Bloomberg. Happy to add people on my distribution list if they want to reach out with emails. And I'm on X, Mike McGlone, at Mike McGlone 11.
Wonderful. Thanks very much for joining me, and I look forward to having you again in person. And if not in person, we'll definitely be doing this over Zoom again out of our respective offices.
Thanks for having me, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.